Hello, hi everyone. A warm welcome to MoneyOwl's insurance webinar. My name is Sean and I'm the lead of the client advisory department here at MoneyOwl. And for some of you who have been following us really closely, this in fact is our second webinar of the year. We have conducted webinar on investments last year, but especially with this uncertainties that have been happening in the past year, with COVID-19, we have never ever imagined a time where all of us would be wearing masks in the streets. I think it really has put risk management, right at the forefront. I think this webinar is really quite timely, and we'll be focusing on how we can mitigate life risk through insurance planning, especially in this year. So a quick introduction about myself. I do lead the comprehensive financial planning team at MoneyOwl, and with I think insurance. As I speak insurance to many of our clients, insurance can be a very complex topic to many of us. Yeah, today insurance is something that cannot be felt, it cannot be touched. Yeah, and while we know that it's actually something really important, at the same time we don't really want to have an insurance payout. Yeah, because that means something unfortunate has happened. Yeah, and I think with that. None of us really, wakes up feeling excited, to get our insurance policies. Probably our first insurance policies, that we have purchased either probably through our friend or family member. But I think we do have a great program lined up for you today. This is going to be a very intense 2-hour session, but we're really looking to simplify, break down insurance planning for all of us, so that hopefully at the end of this 2-hour session, yeah, we'll take away some benefits. We'll understand insurance a lot better of how we can cover ourselves and our loved ones. So let's get started, because I do want to honor all of our time and get started on time, and we have lots to cover today. Okay, and let me first provide a quick introduction about MoneyOwl. At MoneyOwl, we are Singapore's first bionic financial advisor. And by bionic, we mean that we want to provide the best of technology as well as the best of humans. So by technology, we mean that we want to use technology for the precision precision it provides when it comes to financial planning, of how we use complex financial models towards our system. We want to use technology to provide the convenience it allows our clients to assess financial planning. But at the same time, we don't want to lose that human touch. So each of our clients are assigned a dedicated human client advisor. Our client advisors are there to understand our clients' deepest concerns, worries, their aspirations, their goals. Yeah, because really no robots can understand humans than human themselves. Yeah, and this financial journey is going to be a long journey. Yeah, and this financial, decisions that we have to make, yeah, they're going to come up along the way. And we think that providing the best of technology and the best of human, yeah, is going to allow to best serve our clients. Secondly, at MoneyOwl, we are a comprehensive financial planner, and where we want to infuse national schemes entirely to what we do. Yeah, so we do provide a few services at MoneyOwl, of which we have an insurance planning platform where on our website we have an insurance robo that one can easily access, understand what insurance they need, how much do they need. We also have a few 100,000 quotes, yeah, that we compare on our insurance aggregator platform. We have an insurance platform, we have an investment platform as well, where we distribute low-cost, globally diversified investments. We have a wills writing platform as well that is actually complimentary for Singaporeans to write a will. Yeah, and lastly, we have a comprehensive financial planning service where we look at insurance planning, how much do you need, whether do you have too much. We look at projections of retirement planning to see how your retirement income could look like. Yeah, and we put CPF in as well. And CPF is a really complex system. Yeah, where all of us who are Singaporeans, we do contribute a large part of our income to CPF. Yeah, but it can be very complicated, but yet it plays a large part for retirement. Yeah, so what we want to do is to really integrate all of these national schemes like CPF, like Medishield Life for healthcare, like for Eldershield and Cashew Life for long-term care. towards all of the areas of our financial planning so that we provide the complete suite. Yeah. And finally, MoneyOwl, we are an NTUC social enterprise. We were formed 2 years ago as a joint venture between NTUC Enterprise as well as Provident. Yeah, and both these companies have decades of experience of doing good and doing right. Yeah, so whom are the clients that we typically serve here at MoneyOwl? Yeah, first, clients typically come to us because they want to get comprehensive financial advice. So typically not just insurance or investment planning, they are looking for a company they can trust. They are looking for an advisor who can provide them with comprehensive advice, competent advice, as well as conflict-free advice. So you may be pleased to know that, in fact, the entire client advisory team, all of the advisors are all on the internationally recognized certified financial planner program, or in short, CFP. Yeah, so they do have the competent knowledge to be able to serve our clients, as well as, if you do not already know, all of the client advisors at MoneyOwl, we are fully salary based and we do not take commissions. Yeah, and we do not mean, taking commissions is bad. Yeah, but we think that with commissions being involved, it just means that there is a conflict of interest within there. And at MoneyOwl, what we want to do is to remove this entire conflict of interest element so that our clients can feel entirely assured when they receive advice from our advisors. Thirdly, I think for clients that come to us, we tend to want to be really prudent and careful in managing their wealth, especially when it comes to investments and retirement. Yeah, and finally, they want to deal with a company that's really in this business for the long haul. Yeah, so as an NTUC social enterprise, we are not funded by any capitalist firm. We are really here for the long haul, where we are not fly-by-night company where overnight we are not, we could not be sustainable and we are close. We are really here for our clients for the long term. Yeah, so this is a quick introduction about MoneyOwl and who we are. And so what are we going to cover today? Yeah, first I'd like to start with our insurance philosophy. Yeah, and really an insurance philosophy, or having a philosophy, is really providing us, all of us, a guidance as to how we can think about planning for our insurance. You'll probably serve a good 80% of us, most of us here today. Of course, there are exceptions when it comes to following this philosophy, but having this guidance does help us to look at how we can think about our insurance planning in a particular manner. And our insurance philosophy is really deeply rooted into this, about how we can get as much coverage as we need, but paying as little as possible. And I'm going to spend quite a lot of time on that here tonight. Secondly, I'm going to cover, because there are so many plans out there, I'm going to cover various types of insurance plans, from term to whole life, to disability income, and to Cashew life. Each of these plans, how do they work? How do they fit of your needs? And finally, I'll be bringing all of us through a demo with our insurance robo platform. And some of us may already know, at MoneyOwl, we do provide 50% rebates in basic commissions. I'm going to share a little bit more about that, so that you understand about this commission rebates thing a little bit more. And to end off tonight's session, I'd just like to share that, just for this webinar today, we are providing a very special promotion right at the end. So if you're, possibly thinking of getting some coverage, you may want to just tune in all the way to the end for that. Okay, so let's get right into it, and let's start with the insurance philosophy. And that's really, like I mentioned, it's about getting as much coverage that we need, but paying as little as we can. And it really starts off from here as to how, as we look at the role of insurance in our financial plan. Okay, so imagine this is our timeline over here, and we are now all over here, and you are now here on the left-hand side. And you could be 30 years old, you could be 40, or you could be 50, right? So now with this amount of current assets that you have now, where you really want to go is that at age 60, 65, or even 70, you want to accumulate a significant amount of future assets, an amount that is enough, so that you can start drawing down from that Yeah, and most of us think this point as really a financial independence goal. Yeah, where at age 60, 65, we do have the option of stop work if you want to, of slowing down if you want to. For some of us, we just want to retire and not do anything at all. And for some of us, we may also need to fund our children's education needs. Yeah, but this is a very exciting point, all of us want to go to. Yeah, because at this point, yeah, we feel that at this point of time, we are able to have a lot more time to ourselves to enjoy doing the things we like to do. Yeah, perhaps, spending more time with our loved ones, our children, even our grandchildren, come age 68, 65, doing things that we like. For some of us, perhaps we like to, volunteer, for a social cause. Yeah, and this is a really exciting time for us to look forward to. And what we want to do is to build this future amount of assets, yeah, such that we are able to draw down for the remaining 20 to 30 years. Yeah, and this remaining to 20, 30 years is a significant amount of time. Yeah, because during this period of time, we are no longer earning an income anymore, but yet we still have to spend. Yeah, and this makes the period from now till age 60 to 65 really important. And this is a period of time really we are still bringing an income. And this income is going to help us to fund our living expenses now. More importantly, it also helps us to continue to accumulate our assets, yeah, such that we are able to meet our goal. And this is our most important financial asset now. Yeah, it's important that we protect this. But however, along the way of trying to reach our goal, there are life risks that could happen that could severely disrupt this plan. So what are some of these life risks? Yeah, some of these life risks will happen is, of course, if death were to happen. Unfortunately, if we all do not have contract with God, yeah, if premature death were to happen, there's a need. If we have dependents like our parents, whom are still dependent on our income, if we have children who are still dependent on our income, because our income is going to be stopped permanently, there's the need to replace our income to provide these living expenses for them. So that's number one, the first major life risk. The second major life risk that could happen is occupational disability. So if there's an illness or accident that happens and causes us to not be able to work, income stops permanently as well. It's important for us to replace our income, yeah, so that financially, our plan is not derailed, even though physically we may be. The third thing that could happen is really, of course, a medical crisis. Yeah, that's when perhaps cancer could happen, heart attack could happen. Yeah, and when a medical crisis happens, yeah, we are usually concerned with two things. One is if we need an income replacement for a temporary period of time before we recuperate from it and then we go back to work. The second thing that we are concerned with is really due to medical expenses. Yeah, we want to be able to provide for the medical expense due to the medical crisis so that we are sufficiently insured. Yeah, and we don't have to worry about the really high healthcare costs, yeah, that could be incurred. And the fourth thing that could happen is, of course, severe disability. Yeah, and with a severe disability, that's when we are not able to carry out some of our activities of daily living, like feeding ourselves, like bathing ourselves. That's when we will need help. Yeah, and that's when there's a need to provide for caregiving expenses. Okay, so there are many risks out there. Yeah, but if we were to put all of these risks into what I call a risk matrix, yeah, and this is probably what we can do. Yeah, so if over here on this risk matrix, yeah, as I'll be sharing with all of us, yeah, over here on the vertical part, we can see this part on the y-axis, it says frequency, which means how frequent this risk could happen. And over on the x-axis, we have this level of how severe this risk would really disrupt on our financial plan. Yeah, and on this risk matrix, there are really four different items. So if a particular risk is happens on a high probability basis and is going to affect us severely, it's probably best for us to avoid this risk altogether. Yeah. If it's something that's going to happen frequently, yeah, but the severity is low, yeah, then perhaps we can look at how we can reduce, yeah, of this risk happening. Over at the bottom left-hand corner, if the frequency of happening is low and the severity is low, then perhaps we could retain some of this risk. Yeah, and at the bottom right-hand corner, if the frequency is low, but the severity is high, that's how we need to look at how we can transfer this financial risk, yeah, of us away to perhaps another entity, yeah, or company who can take this on. Yeah, I know it all sounds pretty fuzzy at the moment, yeah, but let me go through this a little bit in more detail. Yeah, so same thing, this 4 risks, and let's start with the top right-hand corner again of like, certain risks that we can avoid. So an example of something that happens, high probability and of high severity, that's probably due to gambling, yeah, or if you are trading using money that we don't have, yeah, if we are going to gamble with a lot of money, for example, in 4D or Toto, the chances of losing it all is very high. Yeah, if you don't want to lose so much money, it's probably best for us to avoid this risk altogether. On the other side, if we now move to the top left-hand corner on risks that we can reduce, that's where, there's minor flu, for most of us, you may have a bout of flu, twice or thrice a year. If you happen to be really healthy, you may have it once a year, but we all, in Singapore, we do have the flu seasons. Chances of getting a flu is probably quite high. Yeah, but the severity is, pretty low because, each time a flu happens, if you're employed, if you're someone who's employed, you may just take medical leave for a couple of days, or in this case, you may take medical leave for 5 days now. Yeah, but you're still being paid, yeah, for your salary. Hence, the severity is low. Even if you're self-employed, yeah, I mean, out of COVID situation, with a flu, you may lose your income for 2 or 3 days. I would say that the severity is actually not that high. Yeah, so this, to reduce this flu, for example, yeah, one way is to just, having more sleep, yeah, drinking more, staying healthy. And like for myself, I know that if I were to go through 2 or 3 days with only 4 hours of sleep each night, yeah, I know come to the 3rd day, if I still do not catch up on sleep, yeah, there's going to be a very high chance for me of getting a flu. So that's probably one way of trying to reduce the risk. Now in the bottom left-hand corner, yeah, of something that is low in probability, low in frequency, yeah, and low in severity, one of which is, a loss of income due to loss of job. Yeah, and some of us may wonder, in terms of retrenchment, yeah, isn't this something very severe? Yeah, but if we all, think about it, if we do have a retrenchment in job, for most people, yeah, I'm not saying for all, for most of us, yeah, we are able to find another alternative job. Yeah, we may not be getting the same pay as we used to have before. Yeah, but we're able to find an alternative job. It's whether we like it or we don't like to do that. Yeah, but the loss of income could be lesser. Okay, and another, something that is, slightly lower, in terms of frequency and lower severity is like ankle sprains. Yeah, so, if ankle sprains were to happen, we probably want to retain this risk now because it doesn't really disrupt our income and doesn't disrupt our financial plan. So what are some of these risks that could be transferred? These are the 4 major risks that we, just discussed about. Is income loss due to death, income loss due to either a critical illness or disability, providing for hospitalization costs, and also caregiving costs due to severe disability. Yeah, and that's when, when we look at the transference of risk and we think about what insurance at its core, yeah, what insurance really means. Yeah, it's about transferring this risk of us that we have to another entity. In this case, what we have are insurance companies for us to transfer this risk to. Because what we do is that we are using, a relatively lower amount of cost, or what we call premiums, to be insured for a much larger amount so that we don't have to bear this risk. So that touch wood, in the event of any of these negative situations, if our income will stop permanently, this payout can happen to replace this and altogether. Yeah, and for insurance companies, if they're able the reason why they have created like insurance policies, because they are over a large population, they are able to assess this risk and they are able to offer this, for us to, take up if we need. Okay, so we are going to focus on these four major life risks in particular today. They are once again premature death, occupational disability, medical crisis, and a severe disability. So then, how do we start thinking about how do we cover ourselves? Yeah, now that we understand what are these four major life risks are, may I suggest we first start with the duration of coverage. How long do we need the coverage for? Because not every area of coverage, yeah, we need it for our entire lives. And I'll share this in a little bit more detail shortly. After understanding how long we need this coverage for, yeah, that's when we need to compute how much coverage we need. And I'll cover this in detail as well in this as a second segment. And finally, after we have understand how long we need, how much we need, actually the easiest part to do is for us to know what kind of insurance to purchase. Yeah, and then we'll look at the type of products, yeah, that can cover these areas of coverage that we need. Okay, so let's dive in and let's start with the duration of coverage. So how long do we need? And let's start with, the same thing, this timelines here. And for this, let's start with looking at death and occupational disability first. Yeah, and may I suggest that if you are buying insurance to mitigate against the loss of income due to death, yeah, may I suggest that we can just have this insurance coverage until retirement or until we no longer have dependents at that point of time, whichever is later. So this would be a temporary need. Okay, so let me just share as an example, like for myself, I'm married, I do have a 2-year-old boy. In the case if death or disability were to strike me now, yeah, it's important for me to be able to provide this replacement of income for my wife so that she's able to continue to support my son. And that's when that income replacement is needed, because I would like her to provide for the children's education. I would like her to the family to still carry on life as the normal. Finances, they are not affected. Yeah, hopefully, or maybe, emotionally they are. Yeah, I don't know. Yeah, they could be. Yeah, but this is when, income replacement is needed. Yeah, but it comes to a point of time, where I've attained, this amount of future assets. Yeah, and if death were to strike me after, yeah, that's when I really do not need income replacement anymore. Yeah, because our family would have saved enough. Yeah, they are no longer dependent on my income. My son would have probably have started work already. He's not dependent on me for any finance. Yeah, if I want to leave him, any, coverage at all, it's probably something more optional. Yeah, it's more probably as a gift, but at the point of time, I would have saved up a significant amount of future assets as well. Hence, it's not a priority for me to have income replacement, for a period of time beyond the time when I expect to retire or when I think my child or my dependents are dependent on me. So this is really a temporary need for death as well and occupational disability. Now let's move on to medical crisis. Yeah, and for medical crisis, we are really referring to things like critical illnesses like cancer, heart attack, or stroke, for example. Yeah, and there are really two main concerns. Yeah, first is the loss of income. Yeah, the second is as well as providing for medical expenses. Yeah, and for medical expenses, we can, there are kind of like two areas we need to look at. First is to provide for hospitalization costs. Second is, if we do have, a certain conviction about alternative treatment, which means like going overseas for treatment, or like, for example, particular like PCM, for example, then we may want to provide for that as well. If not hospitalization costs, for a large majority of us, that will suffice. Okay, so for medical crisis, the same thing as well. Yeah, over on this timeline, For income replacement, as we see in this arrow here, it's for us to provide this until retirement, yeah, or when we have no dependents anymore, whichever is later, because what we really want this payout to do, yeah, is to cover ourselves during the period of time where we are still earning an income. For medical expenses, that's where it's important for us to provide for as long as we live. Yeah, and that's something permanent. Yeah, so for medical expenses, for example, like having a hospitalization plan, yeah, that's something that we want to continue to have this lifelong coverage. Okay, so now, if we take the 4 life risks and we put it all together, okay, yeah, this is what we will have in the table. Yeah, first, on death, really to provide for income replacement, this is really a temporary need. Yeah, we don't need it for a lifetime. For a disability, to provide for income replacement as well, this is a temporary need. For medical crisis, for income replacement as well, this is a temporary need because we don't need for our entire life. There will come a point of time where we don't need this coverage anymore. When it comes to funding medical expenses, this would be a lifelong need for hospitalization costs. For alternative treatment, when it comes to funding these medical expenses, yeah, this is a lifelong need. However, we would say that this is of lower priority because not all of us have this condition for alternative treatments. Yeah, and finally, for the fourth need, and that's for severe disability, this to provide for caregiving costs. Yeah, and this will need for lifelong coverage as well. Yeah, so I hope that this is all very clear for all of us that not all types of insurance needs to provide for our life risks are permanent. Yeah, many of them are temporary as well. Yeah, and especially as we have so many needs to meet. Yeah, we have a limited amount of resources where we are trying to fund our monthly living expenses. We are saving towards our goals, our needs, our wants, our children's education, our retirement. Yeah, there's only so much that we can cater towards insurance. Yeah, so like I've shared before, insurance is ultimately an expense, and we want to cover for how much we need, but spend as little as possible. So now that we have covered this part on how long we need, right? And that's the first column. Let's go to the next segment and talk about how much coverage do we need. Okay, so let's start with death coverage again on the amount of death coverage that we need. Yeah, so same thing, the first timeline, the key is for us to cover for this main thing. Yeah, to provide for our income replacement. Yeah, for our loved ones in the event premature death happens. And some of us may have heard, there is like rule of thumb of like, perhaps, all we need is just 10 times of our annual income. Yeah, but, in true fact, yeah, this is just a rule of thumb. Yeah, in fact, for each and every one of our needs, yeah, it really varies. Yeah, depending on all of our circumstances. And in fact, if we do not have any dependents at all who are dependent on our income, then we really don't need death coverage at all. Yeah, let me illustrate this. Yeah, really with an example of how do we compute our death coverage needs. So let's take a case study of John. Yeah, so John over here looking pretty happy, drinking a cup of coffee. He's age 35. He plans to retire at age 57. That's 22 years later. He has 2 dependents. Yeah, he has a daughter, Mary, who's 1 year old, and she's expected to start work 22 years later after finishing her university studies. Okay, so that's how long Mary is dependent on him for. Yeah, and as well as there's Jill, his spouse, who happens to be 35 years old as well, and John wants to support Jill for the next 22 years, and they have this, this goal of trying to retire at age 57. Okay, so when we look at how we want to compute this death coverage for John, over here, and there are going to be quite a bit of numbers that I'm going to flash up. Yeah, first, we look at, gather the income that monthly income that John has. So in this case, John earns a monthly income of $5,000. Currently, his family is dependent on him, for $3,750. $3,750. So that's the living expenses that he has now. The dependency period on here is for 22 years because this happens to be the, the period of time where Mary and Jill are dependent on him for until Mary starts work, or when John and Jill, the couple intends to retire. So if you look at it, if death strikes now, this is the capital that is needed for John, to want to, to be able to provide for his family. So first we take the living expenses, we multiply it by 12 months, we multiply it over 22 years. This is how we compute, $990,000. And this is really what John wants to provide for his family so that life, financially can go on as per normal for his family. And then you look at adding on as well for Mary's tertiary education. So if we build in inflation for education inflation costs, and this is going to be for non-Maxon 4-year education costs in Singapore, it's expected to come up to $170,000 when Mary finally starts schooling in the university. Adding on the home loan, this is the capital needed, of total capital needed for John to provide. But because John currently has certain available assets, right? So we can deduct some of this. John happens to be staying at HDB. He has a home protection scheme, which many of us have. If you happen to own a home, he happens to have his home loan covered fully, so he's able to deduct $300,000 off. He does not have any other insurance at all. He does have some, cash and CPF as well. And he happens to have $160,000 over here. So we can deduct that off because this amount of money will flow to Mary and will flow to Jill upon his unfortunate demise. So actually his shortfall in death coverage. If we take this 1.4 million, we deduct 300K, we deduct 160K, this shortfall of that death coverage, for John comes up to exactly $1 million. Okay, so that's for death. Now coming on to occupational disability. That's for occupational disability, the key thing is to provide for monthly living expenses in the event of occupational disability. There are plans that can provide up to 75% of the income, if you are an employed individual. So if we take, the coverage required for John, happens to be $3,750 per month. This is the amount that he needs to provide. In the event if there's going to be an illness or there's going to be an accident, he's no longer able to work in his own occupation. This is the amount that he wants to cover. And the potential total income replacement out of this is that if an occupational disability strikes today, if John can't work, can no longer work anymore for his entire life, in either his own occupation or related occupations, this plan is, he'll get a total income replacement of 3,750. You multiply it over 22 years, he'll be able to receive a total income replacement of $990,000. Okay, so that's for occupational disability. Now let's move on to a medical crisis. Okay, so in a medical crisis, we've already spoken about, this. The first thing is in the loss of income. For loss of income and in a medical crisis, I suggest, we all be covered between 3 to 5 years of your annual income. And why 3 to 5 years? Because there are studies that show that in the event of a critical illness, for example, like cancer or heart attack or stroke, the 3 to 5 years mark is typically the period of time when, either cancer goes into remission. It's a period of the 3 to 5 years mark. It's a period of time where either, if one has a critical illness, they either starts getting better from the critical illness or they unfortunately succumb to it. And by providing at least 4 years of annual income, this will provide an option for John to be able to spend that time to recuperate. And perhaps after the 4 years, be able to go back to work, to employment, perhaps in a lower capacity. So if we provide for 4 years of critical illness coverage for John. Yeah, this will take, his monthly income of $5,000. We multiply it by 4 years. This will amount up to $240,000. Okay, and so that's the first part they want to cover on the loss of income. Now, the next part that we want to cover is really on the medical expenses portion of a medical crisis. And for this part, the chief of it that we are going to use to provide our coverage for is using a hospitalization plan. And that really depends on one's healthcare expectation. Yeah, so it could be either a government, B2C ward, a B1 ward, or a A ward, or even up to private hospitalization. And we'll speak a little bit more about, this hospitalization coverage and the differences between them, yeah, when we go into, more on integrated shield plans later. Yeah, for alternative treatment, yeah, which can be provided. Yeah, if one has a conviction about it, yeah, may I suggest, yeah, perhaps you'd like to provide, about $100,000 for it if we have that conviction. Okay, so now that we have covered on for critical illness, yeah, let's move on to severe disability. Yeah, and as we discussed, for severe disability, we typically need a caregiver for our needs. Yeah, so some of options of caregivers would be either a family member or a domestic helper, yeah, or to be in a daycare support or nursing home. Yeah, so these are some of the money estimates. So for a family member, typically it's going to be about $600, per month, just to provide for medication, to provide things for consumables that's required during a severe disability. For a domestic helper, if we include like the salary of the helper, if we include the cost of the levy, of the food and lodging, as well as the medication that's required, yeah, for one when they are severely disabled, yeah, this will come up to about $1,200 a month, yeah, thereabout. Yeah, for daycare support or nursing home, yeah, depending on the ward type, severity, or disability, and depending on the kind of nursing home, yeah, that is out there and that one prefers, that could be quite a wide range, yeah, between $1,800 to $4,000. So in this case, John's caregiver preference, yeah, is a domestic helper. Yeah, in my experience, speaking with many people, yeah, most of us do prefer domestic helper to be there as our caregiver in times of a severe disability. Okay, so now that we have, covered all of the severe life risks, yeah, and how much we need to cover all of them, let's put it back into that table again and see what it really means for John. Yeah, so first, when it comes to death and providing for income replacement, we have calculated that, for John, he needs about $1 million in coverage. That is his shortfall. When it comes to disability and occupational disability, he wants to replace. Yeah, he needs to replace at least his monthly living expenses. Yeah, so for him to cover this is for him to cover $3,750 a month. When it comes to medical crises, yeah, and we spoke about covering about 4 years of his annual income so that he has option to recuperate, yeah, during that period of time so that he can perhaps go back to work after. It comes up to about $240,000 for John. For funding medical expenses, and this is for hospitalization coverage needs. Yeah, in this case, John has opted for going for private hospitalization coverage. Yeah, for alternative treatment, yeah, this is at $100,000, but this is of a lower priority if John wants to provide. Yeah, and finally, for a severe disability and a caregiving cost, yeah, John has opted for domestic helper, and this comes up to $1,200 per month. Okay, so now we have gone through the heartbeat, really. We have come through the technical bits and pieces of how long and how much. Next part that we want to go through is really what type of insurance, and that's really the easy part. Yeah, because now we have already figured out the life risk, what area of life risk we want to cover for. We have figured out how long we want to cover for each life risk, how much to cover in each of these areas. Let's look at what are the type of insurance plans out there in order to provide for John. Okay, so for today, We are going to focus on a few types of insurance plans. We are going to cover term life insurance, whole life, occupational disability income, Medishield life and integrated shield plans, yeah, and Eldershield and Cashew life and supplements as well. And Cashew life has been in the news a lot, especially in the last couple of years, because it's been recently rolled out. And we're going to spend quite a bit of time on Cashew life today. Okay, so let's start with the first one, and for term life, which is really the most, I think, most basic and most understandable form of coverage. Yeah, so for term plans, what it really means is that, as the word says, it's a term, yeah, of coverage that it provides for, which means having a term plan provides a coverage for a specific period of time. So it could be for 20 years, it could be for 25 years, it could be until age 65, it could be even for 10 years. It provides coverage for a fixed period of time. So that's why it's called a term plan. By getting a term plan, with a term plan, it provides for pure insurance coverage. So there is no savings element at all. You're just paying for pure insurance coverage. You are getting a term plan. And in fact, because you're just paying for pure insurance coverage, it's actually the most affordable way of getting coverage. Yeah, and I'll explain this a little bit more later of why it's so. And some examples of term coverage, which that's available out there is like to provide for death, provide for critical illness, and provide for occupational disability income. So all of these different types of coverage, they are all available when it comes for term plans. So that's really quick about term, but let's now move on to whole life, and then we are able then to distinguish term and whole life a little bit better. So while there's term, which covers for a fixed period, there's whole life plans as well. And as the name of the plan say, covers coverage for the entire life. And let's break down whole life plans a little bit more. So how whole life plans work is that for every dollar of premium that we pay, what the insurance company does is that they do a split. Yeah, it could be 20% into paying for the insurance cost, and this is what we call a mortality cost, yeah, for the insurance coverage needs. And the remaining 80%, in fact, goes to what we call an investment cost, yeah, where it's invested into the life fund of an insurance company to give some returns on it. Yeah, so it's very clear that this $1 is actually split between these two. Yeah, and what it means by having this 80% into investments is that, for whichever amount of returns that the insurance company can give, yeah, be it, 3%, for example, it's 3% on this 80 cents, yeah, and not 3% of this $1. And in fact, not many of us will be aware of is that actually when we pay, if we do have a whole life insurance and we pay for this premium, a part of this cost does go for insurance cost as well. Okay, so to understand whole life policies a bit better, yeah, the key difference is whole life policies are very expensive because they provide for coverage for the entire life. Yeah, in most situations like we saw, we really don't need lifelong coverage, like for death, like for critical illness. Yeah, so because we don't need, it's important that we only get coverage for what we need. If not, we are just paying a lot more, in terms of premiums. And in fact, if we want to, if you're interested in the investments part, in fact, there are many investment instruments out there which can potentially provide for higher returns, yeah, as compared to just saving up, with a whole life plan. The returns are low, yeah, and for those of us who have come across whole life policies as well, yeah, we may have heard of this break-even point, yeah, where if you get a whole life policy, there could be a time where perhaps 30 years later, with the total amount of insurance premiums that you pay, after 30 years later, at the 30 years mark, you could surrender your policy to get back the amount of insurance premiums that you have paid. Yeah, but while it sounds really attractive, yeah, that getting free insurance coverage in that sense, yeah, the amount of premiums that we pay, initially in the earlier years, the value of the amount of money, the value of money is actually much higher as compared, if you are only going to get the same amount years down the road, because due to inflation, even if you are getting back the same amount of money years down the road in 30 years later, the value of it is actually a lot lower. We can actually buy much fewer goods and services at the point of time with that same amount of money. Yeah, so it's not really break even in that sense because the value is really very different. At the same time, with whole life policy, there's no flexibility. Yeah, there's usually a lock-in period. If there's going to be an early surrender, typically, in the first 5 or 10 years, the monies are stuck. If you do surrender, you are going to suffer, some form of penalty. And I think the most important thing is whole life policies, as we see with the amount of coverage needed, it's very, very difficult to fully cover ourselves with whole life policies because they are just so expensive. So may I suggest that, if we do have, that insurance coverage, do consider term plans because it's really the most affordable way of getting the insurance coverage we need. So at the same time, we are not trying to say that whole life policies are toxic. Yeah, we are just saying that most of the time we really don't need it because most people cannot afford it. Yeah, in certain situations, like, if you want to provide it for newborn, yeah, the premiums can be a little bit more affordable. Hence, it's okay. Yes, it's probably quite okay to get a little bit of whole life coverage for newborn. Yeah, but especially for adults, whole life policies can be very expensive, and we don't want to overly contribute to our insurance premiums. So it's going to draw, our premiums, our expenses away from our other savings needs as well. And we know retirement is very difficult, as a goal to even achieve. Okay, so like I've shared here as well, the key difference between term versus whole life, is that, even with a whole life plan, your, this 20 cents, you are also like being thrown away, to get, the insurance coverage we need. And, this other remaining 80%, we are paying extra to get the returns. And, we have so many options of investments these days. Okay, so the traditional whole life plan, in the past used to be that, the premiums term, we have to, while the whole life coverage, while the coverage provides for the entire lifetime, we will also have to pay premiums for entire lives. However, recently, I would say, perhaps in the last 10 years or so, there's a new form of whole life, there's made available by the insurance companies called the whole life plans with a multiplier. And let me explain how this works. So over here in the top left-hand corner, if one gets a whole life plan with $100,000, in basic sum coverage for death, and $100,000 basic sum insured for critical illness. And this, and an individual gets 5 times multiplier. So what does this really mean? So what this means is that from now till age 70 years old, this plan actually provides a multiplier of 5 times. So instead of $100,000 coverage for death and CI, if death or CI happens before age 70, this, is going to pay out $500,000 upon death or CI because it's multiplied by 5 times. If death or CI happens after 70 years old, this multiplier effect will be removed because it ends at age 70. Hence, if death or CI happens after age 70, there's only going to be $100,000 less. So what does this really mean? And for some of us who are sharper and we can see, having a whole life multiplier plan, it's really akin to like also getting $100,000 whole life plan, something that covers from now all the way for the rest of the life, plus getting a term life coverage, until age 70. So there is a term, coverage element involved as well. So now, we have covered a couple of this, several of these plans. let's put this together for John now. So for now, for death and TPD, okay, and I'll explain a bit more about TPD later. This is for very severe disability. Yeah, we want to, fully replace John's income as well. And for TPD, the premiums are typically a lot lower because it's really meant for severe, really, really severe disability. Yeah. If John gets a term insurance coverage to cover for 22 years, the annual premiums to cover for death and TPD will come up to about $657 a year. But if John gets a whole life multiplier plan of $1 million coverage, yeah, and this has already been multiplied, yeah, the annual premiums for the whole life multiplier plan, yeah, is easily more than seven times more than a term plan, and this will come up to $4,682 a year. Moving on to income replacement of the occupational disability income to provide for $3,750 a month, yeah, over, say, for the next 22 years. This comes up to about $463 for John to provide for this separate occupational disability income plan. And we have seen how this plan is really crucial for John to be able to replace all of his income over the years. And I explained a little bit more about the differences between disability income as well as TPD, yeah, later on. For medical crisis, yeah, and that's the next part that we covered. Yeah, to provide for $240,000, we are using a critical illness rider, yeah, which can be attached on to the first plan. Yeah, and this rider alone will come up to $379 a year. Whereas using a whole life multiplier plan, yeah, for this rider is going to come up to $776 a year. For hospitalization coverage, if John has opted for a private hospital, if we put in a hospital integrated shield plan with a rider, and we'll dive into more details later on, this is expected to come up to $755 a year in terms of cash premiums for John. Yeah, as well as he's able to tap on some of his CPF Medisave account to be able to pay for some of these premiums. For alternative treatment, in the next part, we see that as a lower priority. Hence, John has decided not to take it up. Yeah, for example, because John feels that he wants to set aside enough for his for Mary's education. So let's just leave that out for now. Yeah, and finally, for severe disability, by adding on a Cashew life supplement, yeah, this is expected to come up $386 a year to provide for this additional amount that John needs. So if you put all of this together, yeah, in terms of the premiums, yeah, and also the plans that are recommended, this is how we can think about structuring the plans for John. Okay, so the first plan is going to be a term life plan where the main plan covers for death coverage, yeah, under its main plan. It covers for 1 million coverage, covers for 22 years. There is an additional TPD rider added on for 1 million coverage in 22 years. There's also an attachment of a second rider called the critical illness rider that comes up to $240,000 coverage for the critical illness and over 22 years. For the term life plan, this is expected to come up to $1,000 a year for this plan. We now move on to the occupational disability income part. You have to provide for $3,750 a month in coverage. And for this plan, when there is a payout, this payout can actually escalate by 2% every year, which means, yeah, upon a disability, the first payout is going to be $3,750. Yeah, beyond that, and this is part of the feature of the plan, every year to hedge against inflation, the payout is going to increase by 2% a year. And this will cover John until age 60. The annual premiums for this plan is estimated to come up to about $463 a year. To move on, yeah, to look at John's hospitalization coverage, if we upgrade his MediShield Life with an integrated shield plan, and we attach a rider to it as well, this could come up to about $755 a year in cash, plus $300 a year from his Medisave account, plus the next plan, to cater for severe disabilities, to provide for a Cashew life supplement. Yeah, in this case, we are able to use up to $600 a year from our CPF Medisave account to pay for this Cashew life supplement. For John to provide an additional $600 per month, because for Cashew life, it currently provides about a base $612 a month in coverage. So he needs to provide for this additional amount to provide for his caregiver preference of a domestic helper. This is currently at $386 a year. So we put all of these plans together, and we put all of the cash payments together, we can see that for John, to be sufficiently covered in all of these areas, and we'll see that he's quite comprehensively covered from death, $1 million coverage, from critical illness as well, for occupational disability income as well, for hospitalization, and for Cashew life, for severe disability. The total annual premiums for him come up to about $2,254 a year. Yeah, and this is slightly less than $200 a month. Yeah, which for John and for most of us, we'll find it pretty reasonable. Yeah, for us, especially we have coverage of these needs. Okay, and we have seen that from the previous slide. Yeah, if John had opted for a whole life multiplier plan instead, yeah, the premiums would have been a lot higher. In fact, close to it's going to be high 4 digits. It's going to be $6,000-$7,000 a year, and many of us, including John, yeah, cannot afford that. And so what happens is that because we cannot afford this amount of premiums for a whole life plan, yeah, I've seen what many of us do is to reduce the amount of coverage for a whole life plan. So instead of being adequately covered for 1 million coverage, which is really what we need, yeah, what we then do is to keep the premiums affordable. Yeah, what some people have done is to reduce the amount of coverage for their whole life plan. Yeah, maybe just by half or even by a third. Yeah, or even more than that, to reduce their premiums. Yeah, but what this really means for them is that they are severely uninsured. Yeah, and if this life risk were to happen, yeah, either them or their family members, yeah, would be the one, yeah, who is on the receiving side of it and not getting the benefit payout that they should be receiving. Okay, so I hope this is very clear about how we think about insurance coverage, the different life risks, how long we need, how much we need, the structuring of the plans, and how this really differs from using a whole life plan, yeah, as compared to using a term life coverage. Okay, so with that, yeah, let's go on to the different types of coverage, yeah, that that I thought would be good for me to share about. And the first area is really on occupational disability income. I would say that this particular area is one of the most overlooked coverage. And what does occupational disability income really mean? Okay, so what it does is that for this kind of insurance, or disability income insurance, it can almost fully replace our salary, provide a monthly payout. I think more importantly, it can provide the financial security that we need, because we saw that in the case of John, yeah, over the next 22 years, if he has an occupational disability plan, it can pay out for that almost $1 million. And if you use critical illness coverage instead to provide for this amount of income replacement, it's going to be very expensive. Yeah, hence disability income insurance is highly recommended for using a relative lower amount of premiums to provide for this area of life risk. In terms of the definition of what it covers, yeah, if there is an illness or an accident that leads to one not be able to perform the material duties of either their own or any related occupations on their own, this will already provide a payout. So it may not necessarily be disability. Yeah, it may not necessarily be strict definitions of critical illnesses like cancer, heart attack, or stroke, because for this form of coverage, it's really very job related. Yeah, so it covers for a wide scope as well, where there's this part of in the policy where it says that upon any illness or accident that happens that leads to one not be able to perform their material duties of their own work, this will provide for that payout. Okay, so that really covers a whole entire large area of other illnesses and conditions that may not necessarily be covered by the list of like 36 critical illness conditions that most of us are more familiar with. Okay, and this plan also has this feature that if you are able to return to work later, but if you do have a pay drop, of more than 25% after that, this plan also provides for additional income supplement, to supplement the drop in pay. Okay, so when we look at John in terms of the disability income coverage for John, this is a revision of what we have done. For disability income coverage, what it does is that for employed individuals, it can cover up to 75% of one's income. And there's a reason why there's a limit as well of 75%, because let's say if John earns $5,000, right, and he's able to apply for coverage of up to $10,000. Then there's this moral hazard involved where there increases the chances of John perhaps self-inflicting injury to against himself for him to enjoy this payout. Hence, there's a limit which the insurer set as to how much one can apply for such disability income coverage. So for John, he decided to, the limit that he can apply is up to 75%. For self-employed individuals, it's slightly lower at 65%. And really, for John, in the event of an inability to work, we can see that the potential total payout this plan can potentially provide if an occupational disability, happens to John today. If we take this 3750, we multiply it by over 24 years, this can replace up to $1 million worth of income. And this is a really large amount. And that's where it relates back to where we started from, as protecting our income, because really our most important financial asset is our ability to earn an income. It's important that we are able to adequately provide for this. Okay, so I hope that's clear about disability income. And what I've seen is that in many of the clients that we see and we meet, many of us are lacking of this form of coverage. Okay, so let's move on, and we have a couple of more plans to go. And the next segment is really on MediShield Life and Integrated Shield plans. Most of us will be more familiar with this, but I will do a quick revision of this again because there are some changes recently to Integrated Shield plans and really what it really means for us, so that we have a better understanding of how it works. Okay, so a quick recap about MediShield Life. It is a mandatory, universal, and lifetime basic, and provides for basic healthcare insurance for all Singaporeans and PRs. The key purpose is to help to pay for large hospital bills and for selected outpatient treatments. And it's really targeted at subsidized treatments in public hospitals. So for example, in class D2 or C wards. But with this in place, I think what's beneficial is that for all Singaporeans and PRs, we have a basic level of coverage already in place. No matter what. No matter of any pre-existing conditions that we have, we already have this in place. To help to reduce our healthcare costs. So then, what is an integrated plan? So for MediShield Life, what it does is to provide for subsidized treatments in public hospitals, and this is really for B2 or C wards now. So when we are referring to C wards in government hospitals, there are typically 8-bedder wards. For B2 wards in government hospitals, there are 6-bedder. But if you want a higher level of healthcare, if you have a preference of that, that's when we can add on an integrated shield plan, or in short, an IP. So what an IP does, is to provide a higher coverage to cover the cost of stay in private hospitals, in Ward A or Ward B1 of public hospitals. So for Ward B1, what the hospitals typically provide is a 4 to 6 bedded ward. Typically comes with a television as well. For some hospitals, for B1 wards, it's air conditioned as compared to B2 or C wards. Yeah, for A wards in public hospitals, these are single bedded wards in public hospitals, and these are for those who prefer more privacy. Yeah, and for private hospitals as well. Yeah, and that's a separate class. For example, if you have heard about hospitals like Glen Eagles or Mount Elizabeth, or Thompson Medical, these are all some examples of private hospitals. When we referring to public hospitals, then what we are more familiar with would be SGH, Tan Tock Seng, Changi General Hospital. These are some examples of public hospitals. Okay, so then how do we go about thinking as to whether do we need an integrated shield plan? Yeah, there's just really these 3 key questions to ask ourselves. So first is, whether do we wish to stay in a class A or B1 ward or private hospital? If you do have a preference of the ward, either due to the television or due to having air condition or having a single bedder, then perhaps you may want to upgrade your MediShield Life plan if you have not done so yet. The second key question to ask is, whether we want to choose a doctor. So for B2 or for those of us who are on MediShield Life, typically there's no choice of doctors. Yeah, but if you do upgrade your coverage to at least a B1 ward, there's a choice of doctors that you can have the option to choose. So for example, if you have heard, let's say if, for example, John is warded, and John has heard from a friend or family member that a particular specialist is very renowned in this area, and he has heard from his family member that the family member really trusts this specialist. John may take in his friend's advice, select that doctor, hence having that option to choose the doctor could be important. So that's the next important question to ask. The third question to ask is whether we think there's a difference in waiting time or not. So for some people, they just they think that not that government hospitals, the healthcare level they provide is any lower as compared to the private hospitals. It's only that in public hospitals, in government hospitals, sometimes it can be a bit crowded. And the waiting time could be longer in terms of admission, in terms of having treatments of scan. So if you do think there's a difference in waiting time between a private hospital and a public hospital, perhaps you may want to consider upgrading your coverage. But if not, if you do not have any of these preferences at all, then it's perfectly fine to stick with your MediShield Life coverage of B2 to C wards. So now that we have covered uncovered more about how integrated plans work, let's talk about how riders then work with integrated plans. So on top of MediShield Life, on top of getting this upgrade to reduce the cost of a particular ward that we want, there are riders that we can attach to this integrated plan as well to reduce our out-of-pocket costs even further. And let me just show an example of how one of these riders works from an insurer. Different riders from different insurance companies work slightly different. But I think this provides a good example of how the new riders work. Okay, so let's assume that John happens to be warded, and unfortunately his bill size came up to $200,000. If John only has an integrated shield plan alone, he has not attached a rider. Okay, so just the IP alone only. Now this is what he has to pay. He has to pay the first amount of $3,500, and this is what is labeled as a deductible. Which means no matter what the total bill is, the first $3,500 has to always be paid by him. On top of that, if we remove this first $3,500, meaning if we take 200K, deducting this $3,500, with this remaining amount of 196,500. So if we take 200K again, minus $3,500, with the remaining amount, John has to pay 10% of the remaining amount as well. Yeah, and that will come up to 19,650. So all in all, yeah, even though he has, as an integrated plan, he still has to pay $23,150. Yeah, which is a significant reduction as compared to $200,000. Okay, so now let me share further about what if John has a rider. Yeah, and in this case, if John has a rider and he happens to see a specialist that happens to be on the panel of specialists by the insurer. So what has happened recently is that the insurers have all rolled out new riders, where if one actually sees a specialist that's under the panel of specialists with the insurer, they actually cap the limit, that we have to pay. Yeah, so if John, in this case, visits a panel doctor and he has a rider as well, this could be his possible bill. Yeah, instead of paying this $200,000, he only has to pay 5% of it. But in addition, this rider provides a very useful cap, of capping his total amount that he has to pay of up to $3,000 a year, which means no matter what his bill size is, so his bill size could be even $500,000. Yeah, having this rider actually provides this cap, of him having just needing to pay $3,000 in this scenario. So this can be really useful, and this shows that really, seeing a panel doctor can be very helpful in terms of reducing the cost. Now, on the other hand, what he has a rider as well, but in this case, he visits a non-panel doctor. Okay, this specialist, happens to not be under the list of specialists that is on the panel with the insurer. Same thing, he pays 5% of bill, in this case 10K, but in this case there is no cap at all. Yeah, and in addition to that, there is this additional non-panel payment of $2,000. Okay, so in this case, for John, he has to pay this 10K plus this 2K. He has to pay, in total $12,000. So now, if you look across, all of these three, we can see that having a rider and without having a rider, does reduce our out-of-pocket costs quite significantly. But in addition to that, if we do see a panel doctor that's with our insurer, it can reduce our costs further. And this is just an example of how riders work. Different insurers have slightly different, mechanics of how this works. But by and large, I think the key concept is that, if we do visit a panel doctor, this will reduce our costs quite significantly. So it's important to check this out. In fact, it's quite easily, readily available on our insurer's website as to which of the specialists they work with. Okay, so recently there have been quite a few changes that comes to integrated shield plan riders, and we have heard series of news coming out after one after another. It's important for us to all understand this, because really hospitalization plan is really a key and core part of our insurance coverage. So what are some of these changes? So starting from April 2019, in fact, only partial riders are available. So for some of us, who are aware, there used to be what we call full pay riders, where actually there's no need to even pay a single cent of the bill. The rider can take care of the entire cost fully. But because of rising inflation costs, and because of some people just treating like what we call like a buffet syndrome of going for multiple multiple surgeries or going for treatments that they don't necessarily need, this has really inflated healthcare costs. Hence, that's the reason of introducing these partial riders. So as of April 2019, only partial riders are available with the insurers. The co-payment is capped at $3,000 a policy year for approved treatment and if treated by the insurer's panel of doctors, like what we saw from the example earlier. Yeah, and if it's through a non-panel doctor, there's actually no limit on the co-payment. That's why we saw the cost actually is much higher. Yeah, if there's if one goes and see a non-panel doctor. Okay, so on top of this, there have been like recent developments in the integrated shield plan space recently. Yeah, that even for existing policy holders, so if you may have bought your rider, yeah, your full pay riders or your old riders, a long time ago. Recently, a few insurers have come out to say that they are going to discontinue such full pay riders. Yeah, there is going to be a transition of existing policy holders to the new forms of riders, and they will be subjected to this treatment as well, where only for insurers panel of doctors is capped at $3,000 a year. If it's through non-panel doctors, there is no limit on the co-payment. Yeah, so a couple of insurance companies have already announced this. I believe soon, the other insurance companies will announce this as well, because what is happening in the healthcare insurance costs, in healthcare insurance space, between the insurers is that they're losing millions of dollars every year. Yeah, so this is how they can keep costs low. And as well as for many of us, if we do transit to the new riders, we would see actually our costs come down quite significantly as well in terms of paying for these riders, because the cost of these riders have gone up really significantly as well. Okay, so I hope that's clear when it comes to hospitalization plans and some of the changes that are happening. Yeah, let's move on to the last part of the plans that we want to cover, and that's really on Cashew Life. So in short, we call it CSL. On top of CSL, if you want to do a top up to it, these are called supplements. Yeah, we call it Cashew Life supplements. Okay, so for long-term care, this is the landscape that we have here. Life expectancy is, in Singapore is increasing longer and longer. In fact, it's good news, I guess, that we have the longest average life expectancy in the world. It currently is now at about 85 years old that we are expected to live to. Yeah. MOH has also recently done a study, and they found that about 1 in 2 Singaporeans who are healthy at the age of 65 will go on to develop a long-term disability. And this is, to me, a really startling statistic. Yeah, that almost 50% of those who are healthy at age 65 will suffer some form of disability. If we look at, depending on when the disability happens, there may be a chance that we spend quite a number of years in disability rather than in good health. So that's when there's a need to provide for caregiving costs. And when we look at severe disability, the definition is the inability to perform 3 or more activities of daily living. Now, so if we look at these 6 activities of daily living on our screen here, in fact, these are activities that we do within even the first 1 hour of when we wake up. So what we do when we wake up is that we get out of bed. That's transferring. We typically go to the toilet. We may change out. That's when we dress ourselves. We may wash up before we go to work. And that's when we have our breakfast. That's feeding. And then while moving from activity to activity, we are moving around, and then we are if we are heading to the workplace, we are going to work. So these are really the key activities, the key 6 activities of daily living. And the definition of a severe disability is really the inability to perform any 3 out of these 6, like independently, with or without any mobility aids. Okay, and with that, there's actually some form of coverage already that that has been rolled out in the past. So for the first form of coverage that's been rolled out for Singaporeans was really Eldershield. And this is no longer being issued anymore. For those of us who are on Eldershield, we are still being covered with this. But this this Eldershield coverage, has been rolled out until 2019. where those of us whom are 40 years old, yeah, before 2019, yeah, actually there is no underwriting required. We are automatically enrolled in unless we have already opted out. Okay, the second for Eldershield is that the premiums are payable up to age 65 years old. We can fully use a Medisave to pay for this Eldershield premiums for those of us who are on Eldershield. There have been two forms of Eldershield that we rolled out. When it first started in 2002, it was called the Eldershield 300. Yeah, we provided a very basic $300 per month payout upon the inability to perform 3 out of 6 of activities of daily living. And the payout just happens for 5 years. And then that's it. Yeah, so even if there's, if there's a longer period of severe disability, the payout stops. And then there was an enhancement in 2007, yeah, where they call it the Eldershield 400. It was enhanced a little bit. Instead of a $300 a month payout, it's been enhanced to $400 a month payout. The payout continued for slightly longer period of time for 6 years. Yes, and by now, if you're all aware now, yeah, we all should be aware now, this, about a couple of years back, yeah, there was a launch of this Cashew Life. Yeah, and what this does is to really relook into this whole long-term care situation here in Singapore, especially as we have an aging population. And so what's the difference when it comes to Cashew Life? Yeah, for Cashew Life, it is a mandatory and universal coverage for all Singaporeans and PRs, which means there's no way to opt out of this Cashew Life. Yeah, the premiums are fully payable by Medisave, so there's no need to, for us to expect anything that we required from our cash to pay for this. The payout starts higher from $600. So in fact, $600 was for last year. The payout in fact increases by 2% every year, at least for the next 5 years, yeah, which they have set out to increase this by. Yeah, and this payout, can pay out for a lifetime. So the premiums and coverage will increase yearly. So what happens is that, let's say, if a severe disability happens, 10 years from now till 10 years later, our premiums that we pay will increase by 2% every year. The coverage that we have, in this case, it was $600 last year. This year is already at $612. It will also increase along the way. But at the 10-year mark, once that payout starts, perhaps, it'll be close to $700. Once the payout starts, the monthly payout remains fixed for life. Okay, and I'll illustrate this with a few examples later. Okay, but before that, I think it's important to go through this for all of us because we all, come from various places. So who does Cashew Life really cover? So if you are born after 1990, once, you will automatically be covered by Cashew Life at a point where you turn age 30 years. So you will receive, a letter saying that, you'll be enrolled into the program. Yeah, so it's very easy to know that you've been enrolled. Yeah, if you are born between 1980 and 1990, so this is when you are between the ages of 30 and 40 years of last year. Yeah, in fact, as of 1st October 2020, that's almost 5 months ago, yeah, you would have already been automatically covered by Cashew Life. Now, if you're born, between 1970 to 1979, yeah, it has been announced that there'll be, automatic enrollment from the end of 2021 if one is not severely disabled. So this provides the ease of administration. Yeah, but for those who are, and for this, if you're born within this period, you have already been on Eldershield. Yeah, if you don't want to be covered by, Cashew Life for whichever reasons, yeah, you can choose to opt out. And the deadline is currently set at December 2023. Yeah, and for those who are born, 1979 or earlier, there is this no automatic enrollment. So by the end of this year, which they'll announce, yeah, you can choose to apply to join from the end of this year if you're not severely disabled. Okay, so I hope this is very clear about the coverage of Cashew Life. Yeah, now if we look at the differences between Eldershield and Cashew Life, yeah, we can see that, first the starting ages of, Eldershield and Cashew Life, they are different. Yeah, Cashew Life, starts coverage from a younger age, from those of us who are 30 years old. Yeah. For Eldershield, there's an option to opt out. For Cashew Life, there's no option. In terms of payout for Cashew Life, it's a much higher enhancement, and this provides for at least $600 a month that started last year. So as of this year, it's already at $612. And with this $600, you can provide for basic caregiving need of a family member. And that's how they have structured the payout for Cashew Life to be. In terms of payout duration for Cashew Life, it's a lifetime of payout duration they can provide. In terms of coverage and premiums for Cashew Life, it can increase. They are currently set at 2% in terms of increase per year from now till 2025. Yeah, in terms of premium subsidies from the transitions, the government will provide some of that. Yeah, and the last age of premium payment, just slightly higher. Yeah, age 67 for Cashew Life. Now to provide for some, Cashew Life payout examples. Yeah, I've sought to find this illustration. Okay, so over here we can see that in this case, let's look at Adam, Betty, and Carl. Yeah, and all of them have been enrolled into Cashew Life at age 30 in 2020. Okay, so when Adam becomes severely disabled, and it happens, at a very young age, unfortunately, he becomes severely disabled at age 30. He makes a claim. Yeah, after making the first premium payment, the premiums will stop. Yeah, because he fulfills the claim criteria. He will get $600 per month. Yeah, payout for as long as he remains severely disabled. Okay, and this $600 a month remains constant once the payout starts. Now let's go over to Betty. So Betty, becomes severely disabled. Yeah, and in this case, Betty becomes severely disabled at age 31. Yeah, she will stop paying premium from 2021 because, unfortunately, she's severely disabled. Because there's an increase in coverage over from, year 2020 to year 2021 by 2%, Betty receives $612 per month from, the point she's disabled for a lifetime. Now let's look at another case for Carl. Yeah, and Carl happens to be, severely disabled in year 2057, at a much later age, at age of 67. His payment will stop at age 67. Yeah, by the time at age 67, the amount of coverage is expected, to have gone up by about, it could have gone up to until about $1,200 a month. He will receive $1,200 a month payout for as long as he remains severely disabled. Okay, so then, now that we have covered about Cashew Life, and I think, by now we are all very clear about how it works. So then what is a Cashew Life supplement? So a Cashew Life supplement is really just a top-up, of our Cashew Life coverage. So if you find that $600 is insufficient to provide for our caregiving needs, that's when we can, decide to top up our Cashew Life coverage. So currently, for all of us, we are able to use up to $600 a year from our MediSave accounts to provide for this top up. And in addition to that, in addition to providing for a higher amount of payouts, some of these supplements have this feature, where it makes the claiming criteria more lenient when it comes to the supplements. So instead of having, only being able to claim, upon the inability to do 3 out of 6 activities of daily living, there could be a possible claim, at 2 out of 6 activities of daily living, and some of these insurance supplements to provide for that. Okay, so now we have spoken quite a bit, and we have used many, by now you have realized that we've used many disability terms along the way. I've spoken a little bit about total permanent disability, TPD. I've shared a little bit about disability income as well. And then I shared about Cashew Life as well, which covers for severe disability. So how do we really differentiate between these 3 forms of disability? So a good way to look at it Yeah, between TPD, disability income, and Cashew life, yeah, is through this table. So firstly, the difference between them lies in the definition of each of this coverage. Okay, let's start with Cashew life first, because we just, completed that part. We are all very clear that in the event of the inability to perform 3 out of 6 activities of daily living, they will provide for that payout. Yeah, and this really is to provide for caregiving costs. For TPD, yeah, with some of this have this attached to our main life plan. Yeah, there are several ways TPD can pay out. Yeah, the first is also the same as Cashew life, and that's the inability to perform 3 out of 6 ADLs. The second is the loss of use of 2 parts of either the eyes or limbs. So it could be 2 eyes, or it could be 1 eye or 1 limb. And this limb, this limb could be our hands or legs, but it must be above our wrist, or it must be above our ankle. So any loss of use of 2 parts permanently, that is considered a TPD. A third coverage definition is the inability to perform any occupation at all, then it constitutes a TPD. Yeah, so in any of this, the TPD payout can happen. Yeah, so we can see that when it comes to TPD, it's a very stringent form of coverage. It's really for very, very severe form of disability before this can pay out. The key difference between a total permanent disability coverage, TPD, and a disability income is that the disability income is very job related when it comes to the coverage definition. So for disability income, it's only when there's an inability to perform either our own or related occupation to our own, or through our experience and education, then this can already provide a payout. So it's actually a more lenient form of coverage definition as compared to TPD. Okay, so if you look at the role it plays in our insurance plan, yeah, for TPD it can provide replace their full income or living expenses. Yeah, for disability income, it can do that as well with a more lenient way of claiming. Yeah, and for Cashew life is to provide for the additional caregiving costs, yeah, which will be incurred in the event of a severe disability. Yeah, if we look at the coverage period, this is very key. Yeah, because if we see some overlap, yeah, between TPD and Cashew life, yeah, it's actually not. Yeah, and the reason why it doesn't really overlap is because Cashew life provides for lifelong coverage, and we know that this severe disability, tends to happen in our old age. Yeah, hence it's critical for us to be covered for severe disability in our old age. Yeah, but for TPD, yeah, it typically covers up till age 70 years old. Yeah, even with whole life policy. So even if, for some of us, we do have whole life policies, even if we have a TPD rider attached, yeah, or embedded within the plan, there will, be a clause that typically up to age 65 or 70, this TPD coverage ceases. Yeah, that's why there's a need for providing Cashew life coverage. Yeah, and for disability income, like I've shared, the main purpose is to provide for income replacement, and it's a more lenient form of coverage. That's where it serves it's the entire picture. So while we have heard so many forms of disability, I hope this table provides a clear distinguishment between these three. Okay, so now we have covered really we've gone through all of the hard part, yeah, about our insurance philosophy, what are the life risks to cover, how much we need, how long we need, how much we need, what type to cover. We have understood various plans as well. We all of us can be quite proud of ourselves to now be able to understand quite a lot about insurance. Yeah, now I'd like to share about how you can actually do this insurance planning here with MoneyOwl, because as I shared, many of these computations, recommendations, yeah, are through complex computations of it's through like various systems or various processes in terms of recommending the plans. Yeah, if you want to just have all this ease, yeah, you can consider using this really simple insurance planning robo that we have on our website. Yeah, so now let me share my screen, to just do a demo of how this insurance planning journey looks like on our website. And if you are still with us, do hang on. Do hang on till the end of the session, because I'll be sharing with all of us a really special promotion, just for the attendees of our webinar. Okay, so this is our MoneyOwl website. So if you go on to the header here, www.moneyOwl.com.sg, this is our homepage. To start off, you may just want to scroll over to services, and this is the first, this drop-down list right at the start. We do have a few planning services like first share at the start of the webinar, but in this case, what we want to look at is insurance. So you can just click onto insurance. And that's where you will land on the insurance planning webpage. Right in the middle of the screen, you will see these two buttons over here, and that's how find out what I need. That is, if you really don't know what insurance you want, like John, he may not know. If there's something that you already know that you want, you can just click on compare insurance. But in this case, let's try out and click on find out what I need. So the first thing that comes out is that we ask, what's your profile? Because we want to understand the different life stage that you are in, and for different life stages, the insurance needs are very different. So for example, if you're a retiree, probably don't need any death coverage. But if you're a parent, and let's, in the case of John, and we're going to use John's profile. Let's select that I'm a parent, and then we can click continue. And then we ask a few simple questions to get started. So in this case, John's a male, he's born on 1st January 1986. He's 35 this year. And he has two dependents, if you remember. That's Jill and Mary. Okay, so then, immediately a whole suite of protection needs come up as priority. So we would see, these are the various kinds of insurance coverage and life risks that we spoke about. So in this case, John wants to have a look at all of them. So he leaves all these boxes checked, and then you can click continue. And the next part is the financial assessment, where this where what we do is to gather information on the income, expenses, or assets, for us to determine the insurance coverage that John needs. Then you can click on proceed. So in this case, the first part is on income. Let's input that John has $5,000 a month in terms of salary. He has no annual bonus or other income, and let's click continue. Okay. In terms of expenses, let's say John has 1,750 in terms of monthly installments that he has to pay. In terms of other expenses, let's just put in $2,000. So in total, 3,750, and we can click continue. And now on understanding assets, okay, so for John, he has $100,000 in cash, and his CPF, his combined balances come out to 6,853, for example. Perhaps he has just purchased a new home. So he's still trying to accumulate more towards his CPF. And then he has a property as well. So he has a HDB. So let's put in his property value at $400,000. And he has no investment properties, no investments, and we leave it blank. So you continue. So on liabilities, let's just put in that he has a $300,000 property loan left to pay, and he has no other loans. So let's click continue. Okay, and next part is on insurance needs assessment. So let's click proceed. And this is where more information, it's being gathered on the dependent. So the first dependent, which we want to input is for Mary. So Mary is currently 1 year old. It's John's daughter. And let's just put in the supporting amount for Mary, about $750 a month now. And John wants to provide for Mary for the next 22 years. Okay, so if you have any like questions about how to compute these years needed, we have this tooltips here, yeah, for you to click and to find out more information. Yeah, and John wants to provide for Mary's education as well. Yeah, so in this case, he wants to provide for non-Maxon, yeah, education here in Singapore, and Mary is a Singaporean. Okay, so let's go on to the next dependent, and the next dependent is Jill, Jill's spouse. Let's input that. So Jill happens to be 35 years old as well. Okay, and the support amount for Jill is $3,000 a month, for example. And yeah, in our case study, they want to be covered for the next 22 years. Okay, so now we have done that. Now let's click continue. Okay, so the next part, now they've covered the front part. The next part is on critical illness. And so there's a recommendation here of, between 2 to 5 years. In this case, yeah, over this scroll bar, when I'm circling now, John wants to provide for 4 years of annual coverage for annual income replacement in the event of critical illness. So let's put it at 4 years. Yeah, and let's say John wants to provide for coverage until say age 60 years old. Okay, so we can put that and we can click continue. For occupational disability, that's when here there is a scroll bar to say the percentage of monthly salary John wants to replace. Yeah, so in this case, John wants to replace 75% of the annual income. So we put in 75% and then until age 60, and we can click continue. Okay, the next segment is really on hospital plan. And in this case, this comes out with a list of options for John's preference. And in this case, John wants to have up to a private hospital coverage. So you can click on that and click continue. And finally, on long-term care coverage, yeah, there's this options that all come up. In the case of John, he wants to have a domestic helper, yeah, to provide for his caregiving. So let's select that and click continue. So really quickly, in our insurance robo engine, yeah, this comes out, the calculation of needs in each of these different areas. Yeah, so we'll see that a life protection needs is 1.3 million, yeah, and so forth. Yeah, and there's this orange button here at the bottom where we can add existing coverage. If you recall, yeah, John has a housing protection scheme, right? Coverage, and that covers his home loan. So we can input the $300,000 coverage that we have, and then we can just click save. And this will immediately reduce the amount of life protection needs. Yeah, and similar to our case study, this will provide for see the insurance recommendation is exactly as to what we have gone through, less all of the computations, and this is really, up to a 5 to 10 minutes, 5 minutes work as to input just inputting the information that you have. And this whole suite of recommendations come up. So you want to view details of the computation, you can click in, and that's when we review how we calculate the different amounts. Yeah, and if you want to proceed, you can just click on continue to recommendations at the bottom right hand corner of the screen. Yeah, and that's when it comes up with a whole suite of products. Yeah, compared across various insurers. So the one that comes up, yeah, is actually currently the one of the most affordable plans. But if you are interested in, for example, in any of these products, yeah, you can just select plan, submit an inquiry, and that's when an advisor will get in touch to look at the plans for you to ensure that you're getting the best value plans for your own needs. Yeah, so over here at the top, you can see the different plans come up for the different coverage. Yeah, I think this is a really useful tool for anyone who really don't know what coverage that you need. Okay, so this is really on the guided journey that I wanted to go through. Apart from that, yeah, we do have we now come back to our insurance landing website. We do have this separate second button over here called compare insurance over here on the right hand side. So if you click on compare insurance, if you do have a specific amount of insurance coverage that you already know that you are looking for, yeah, to compare that, yeah, for example, there's over here at the top, there's a list of cards for you to click on what kind of coverage you're looking for. We have included education savings plans as well. We have included retirement income plans as well. We have included SRS approved plans as well. But let's say in this case, you're just looking at life protection plans. Yeah, if you want to look at occupational disability income, you can as well. But let's look at life protection. So in this case, let's say for John, he wants to find out for $1 million of coverage alone. Okay, and he says that, okay, maybe I'll just leave out critical illness for now. And then he wants to be covered until age 60, and then he doesn't need any additional critical illness coverage. Yeah, so he's going to leave out the critical illness part. He's looking at just $1 million there. So if you click search plans, that's when a whole list of comparison of the different cards come up on the best value plans that we offer here at MoneyOwl. Yeah, so it's a really simple tool to use. Do play around. Yeah, if you want to sort by different settings by financial rating or highest ranking. By default we rank it based on our own ranking, and that's by value for money. Yeah, so in this case, Manulife happens. So if you're interested in this, you can just click select plan, and you can click proceed at the bottom. That's when you could create a MoneyOwl account. Yeah, or you could fill up this form here. If you click send, a MoneyOwl advisor will get in touch with you really quickly. Yeah, and what they'll do is to understand your needs a bit better, to understand your needs for coverage, and to confirm which plan actually works best for you, because sometimes the insurance companies will offer different promotions at various times, so they'll just do that double check. Yeah, and you will have a human advisor speaking to you. Yeah, because for insurance, it's still best for us to be very clear of what we need. Okay, so I encourage all of us to give it a try, because it's really simple to use, and behind all the complexities that we have covered now, for the almost past 2 hours, this is all really done up in a very user-friendly format. Yeah, here at MoneyOwl's website. Okay, so that's a really quick demo, and let's go back to our main deck of slides. Okay, so let's come back to our main deck, and that's a quick demo of of how you can get started on your insurance planning. Yeah, so just head on to moneyowl.com.sg. Yeah, if you don't really know already, I just wanted to cover this bit about commission rebates. Yeah, so at MoneyOwl we do rebate up to 50% of all of basic commissions, and from time to time we do receive some questions here and there. Let me try and address some of them. Yeah, the first is, whether is it legal at all for MoneyOwl to provide this commission rebates? So the clear answer is yes. MAS have clearly stated yes, because back in 2002, MAS has actually lifted the ban in the provision of commission rebates. But what is important and what is clear is that commissions rebates should not be used to induce one to purchase a policy, which means, you can't say that, we never, that, for example, MoneyOwl doesn't inform you we are providing a commission rebate, but, let's say if you only come to us, then we inform you. So to do that, our commission rebates are fixed, and they are stated upfront, clearly in front, that is imbued as to what we do. And as with each of our clients, they go through a detailed needs analysis with advice of salary-based advisors before a product is recommended. Okay. The second part is, why do we provide such a benefit? Yeah, and there are some reasons for that. Yeah, because and these are some of the key reasons. Because for commission-based advisors, the prospecting for clients is really costly and time-consuming. Yeah, but by being very bionic, MoneyOwl, what we do is we harness the power of technology. We do a lot of digital marketing. The cost of client acquisition is actually much lower. Yeah, and together with our fully salaried advisors, this is where we can pass on some of this cost savings in the form of commission rebates. Okay, so just to provide for an example, so let's assume there's this plan with John. Yeah, so his annual premiums is at $1,000 a year. Yeah, if we rebate 50% of the basic commissions after deducting for admin charge. These are the estimated amounts they will get back. Yeah, net. Yeah, so in the first year, the commissions that MoneyOwl receives from the insurer is typically higher. So you receive 258 in the first year. In the second year, it's about 127. The third year is about $9. So, adding up together, John does receive quite a bit, yeah, in terms of commission rebates. And this amount is credited directly into John's bank account in cash. Yeah. So some other, questions that came up to me along the way is that, whether are there any differences, in terms of policies, whether, purchasing from MoneyOwl or purchasing directly the insurer. The answer is that the products are exactly the same, be in terms of coverage, be in terms of features. Yeah, the premiums offered by MoneyOwl as well as from the insurers are exactly the same as well. In terms of the level of client servicing, yeah, you will have your dedicated client advisor to serve you. In the need of any administrative needs or any claim needs, do approach your client advisor, and the client advisor will be there assisting you throughout. Yeah, and they are your trusted financial advisor. And on top of that, we also have a team of client service managers who stand by ready to assist all of any claim needs. Yeah, so I hope that's really clear when it comes to commission rebates, and this is one way of getting insurance and lowering your cost of getting insurance even further. Okay, so now that we have come towards the end, I really just want to round this webinar up, and thank you very much for all of us who have stayed through all of this. And really, when it comes to the end, this is really the true purpose of insurance. Yeah, and that is during our financial journey, what we want to do is to transfer this risk that we have, especially our income earning years, yeah, to another entity, and this is to insurance companies. What is important for us is that we need to make sure that we are adequately insured ourselves, yeah, for ourselves and for our loved ones. We want to use as little expense as possible to pay for insurance, because we know there are so much needs in life. Yeah, it's not just all about insurance. Yeah, we need to save for our children's education. We need to save for our retirement as well. So it's not just all about insurance. And I'd like to encourage all of us, to relook into our insurance needs. If you have any, if you need any advice as well, do approach MoneyOwl and our advisors who will stand by here to provide you with the most competent, conflict-free, and comprehensive financial advice. Okay, and just to round that up, and just for this webinar only, and this, this exclusive to this webinar, instead of a 50% rebate in basic commissions, just for this webinar, attendees of this webinar, we are providing a 60% rebate in commissions when you purchase with us. Now, all you need to do is to present your event registration email when speaking with our client advisor. Yeah, so if you, if you have forgotten what your event registration email is like, it's the one, there's a confirmation that you have been registered. Yeah, just share that with your client advisor when you inquire through MoneyOwl, and you will enjoy even a higher amount of commission rebates. Okay, and the deadline to do this is up till the end of this month, up to 31st of this month. Yeah, so if you feel that, maybe you just want to have a review of your insurance coverage needs, just feel free to get in touch. We'll be happy to speak to you to ensure that, both yourself, your family, and your loved ones are adequately insured. Okay, and finally, to end off, do let us know what you think. Do let us know what you think. I will really appreciate if all of us could scan this QR code or head over to this link over here to provide some feedback about this webinar, and also let us know about what are some of topics that you'd like to hear about, and we'll take that into consideration in terms of planning for our future webinars. So with that, thank you, and I wish you a very good rest of the week ahead, and I wish all of us the best of health.